The strengthening of the US dollar against the Iraqi dinar at the close of Wednesday's trading in both Baghdad and Erbil reflects a continuation of pressures that have been building in the currency market over recent weeks. The move to 148,100 IQD per $100 at the Al-Kifah and Al-Harithiya central exchanges, up from 147,500 earlier in the day, may appear modest on the surface, but it carries important signals about supply, demand, and market sentiment. When combined with higher selling prices at local exchange shops in Baghdad and similar gains recorded in Erbil, the data suggests that the dollar remains firmly in demand and that confidence in short-term dinar stability is still fragile. One of the main reasons behind this upward movement is persistent demand for dollars from importers. Iraq's economy relies heavily on imported goods across almost all sectors, from basic food items to electronics, construction materials, and industrial equipment. As traders and businesses secure foreign currency to finance shipments and settle international contracts, pressure builds in the local market. Even when official channels supply dollars, delays or procedural complexities can push businesses toward exchange shops, increasing demand and driving prices higher. By the end of the trading day, the difference between the central exchange rate and the rates offered by local exchange shops is also telling, with selling prices in Baghdad reaching 148,500 IQD per $100 while buying prices stand at 147,500. The spread reflects both transaction costs and risk premiums. Exchange shops often price in uncertainty, anticipating further increases or potential tightening in dollar availability. This behavior can amplify small movements, especially when traders believe that upward momentum may continue in the coming sessions. Market psychology plays a crucial role in this environment. Currency markets in Iraq are highly sensitive to daily signals, and even minor intraday increases can influence expectations. When traders observe the dollar strengthening by the close, it reinforces the belief that holding dollars is safer than holding dinars in the short term. This mindset encourages precautionary buying, not only by businesses but also by individuals seeking to protect savings, which in turn adds further pressure on the dinar. In Erbil, the similar gains recorded at closing indicate that the trend is not confined to Baghdad alone. The selling rate of 148,400 IQD per $100 and buying rate of 148,350 show a relatively narrow spread, suggesting orderly trading conditions. However, the overall level confirms that the Kurdistan region is experiencing the same forces at work as the capital. Improved connectivity between markets and faster information flow mean that price movements in one city quickly influence others, reducing the chances of prolonged regional divergence. Looking ahead, short-term predictions point toward continued firmness of the dollar unless there is a clear intervention or policy signal that alters expectations. Demand for imports is unlikely to slow significantly, and businesses may accelerate dollar purchases if they anticipate higher rates in the near future. This front-loading of demand can keep the dollar elevated even in the absence of new shocks. As a result, rates may hover near current levels or edge slightly higher in the coming days. The role of the Central Bank of Iraq remains central to the outlook. While the bank has the capacity to influence the market through dollar sales and regulatory adjustments, it must also balance external obligations and compliance requirements. Measures aimed at improving transparency and aligning with international financial standards, though beneficial in the long term, can temporarily constrain liquidity. If market participants perceive these constraints as limiting access to dollars, they may continue to price in a premium, sustaining upward pressure. Oil revenues provide an important counterweight in this equation. Iraq's foreign currency earnings are heavily tied to oil exports, and stable or strong oil prices can support reserves and enable intervention when needed. If oil inflows remain robust and are efficiently injected into the financial system, they could help ease dollar shortages and stabilize the dinar. However, the timing and visibility of such support matter. Markets respond not only to fundamentals, but also to confidence in how and when those fundamentals will translate into actual liquidity. External factors also influence the local exchange rate. Global strength of the US dollar, driven by expectations around US interest rates or geopolitical uncertainty, can spill over into Iraq's market. When the dollar is strong internationally, local traders often anticipate further gains and adjust prices accordingly. This external backdrop can reinforce domestic pressures, making it harder for the dinar to recover quickly, even if local conditions improve. Inflation expectations are another layer shaping market behavior. A weaker dinar raises the cost of imported goods, which can feed into higher consumer prices. If households begin to feel the impact through rising living costs, demand for dollars as a hedge may increase. This creates a feedback loop where expectations of inflation drive currency demand, which then contributes to further depreciation pressure. Despite these challenges, the current movements do not suggest a sudden or uncontrolled slide. The increases observed on Wednesday are incremental rather than abrupt, indicating that while the market is under pressure, it remains relatively orderly. This distinction is important for predictions, as gradual movements allow policymakers more room to respond and adjust without triggering panic or speculative runs. In the near term, much will depend on daily liquidity conditions and official communication. Clear signals from authorities regarding dollar supply, policy continuity, and market oversight can help stabilize expectations. Conversely, ambiguity or unexpected regulatory changes could reignite volatility and push rates higher. Traders will closely watch whether the gap between central exchange rates and street-level prices widens or narrows, as this often serves as an early indicator of shifting sentiment. Erbil's relatively tight buying and selling rates may continue to act as a stabilizing reference, but this will only hold if access to dollars remains consistent. Any disruption in supply, whether due to administrative delays or external factors, could quickly be reflected in wider spreads and higher prices. Given the interconnected nature of the markets, such changes would likely be mirrored in Baghdad shortly afterward.